Hey, welcome back. It's Jason Walter here. I have a lot of housing market updates to share with you today, including a quarterly forecast of what we should expect to see in our housing market next year. I also have a report regarding housing affordability and mortgage interest rates, as well as mortgage applications. So a lot to share with you today, so let's go ahead and dive into the video. Okay, the first thing I want to share with you today is the Freddie Mac's quarterly forecast. So I'm just going to share my screen with you today. It's going to be a lot easier to show you this information through just sharing my screen. So here we go. So Freddie Mac's quarterly forecast. They are basically forecasting what we should expect next year. And they just published this about an hour ago. I actually posted my own real estate market prediction video. I'll leave a link up here if you want to go check out that video. But it more or less coincides with what Freddie Mac is saying as well. So they're saying that even as the economy faces challenges from the coronavirus pandemic, the housing market has been showing strength. And this is from Freddie Mac's chief economist. And he said that refinance activity is solid and homebuyer demand continues, resulting in increased sales and acceleration in home price growth. Another thing to add there, obviously, is the lack of housing inventory that is fueling this price growth as well. They're saying their forecast for next year for an average 30-year fixed rate mortgage is going to be 3% in 2021. This year, they are expected to be 3.2% on average. Obviously, we're at 3% or lower right now, but that wasn't the case before this pandemic hit in March. In addition, house price growth is expected to increase at an annual rate of 5.5% in 2020. Obviously, we're seeing a huge price growth right now, but not at the levels we saw early on in Q1 this year. And they expect in 2021 that this home price growth is going to be 2.6%. Home price growth, 2.6%, which also coincides with my prediction as well. I don't think we'll see the pace that we saw this year for home prices, but I do believe that homes will continue to increase in price due to the lack of inventory and also the low interest rates. And I'll go over interest rates here in just a little bit. Home sales are also expected to increase in 2020 to 6.2 million homes and decrease in 2021 to 6.1 million homes. So they're saying that home sales is going to decrease slightly. I imagine this is probably due to lack of housing inventory. There's also say that refinance originations are expected to be $2.1 trillion in 2020, which is a staggering number. And they're saying it's supposed to fall to $1.2 trillion in 2021. So refinances, they are forecasting to be about half in 2021 compared to 2020. And I believe it's probably because we had such low interest rates this year that a lot of people are going to refinance this year, and therefore the refinance pool is going to be lower next year. We will see though. Overall, the forecast expects annual mortgage origination levels to be about $3.6 trillion in 2020 and $2.7 trillion in 2021. So we're expecting to have not as many loan originations next year. So that's the Freddie Mac quarterly forecast, just released about an hour ago at the time of this video. So let's go ahead and dive into what we're seeing in the mortgage industry for mortgage applications. So according to the MBA, or the Mortgage Bankers Association, I obviously talk about entity quite a bit on my channel, but they're saying that mortgage applications decreased 0.7% from 1 week earlier. And this is for the week ending October 9th, 2020. At the time of this video, it is October 14th. So the question is, it's middle of October. We tend to have a slowdown in our real estate industry in around September, even August every year. It's a seasonal fluctuations in a real estate market. So is this slight decrease of mortgage applications a reflection of that? Are we going to be going into a typical slow fall? We have not seen that yet, but we'll have to wait and see how this number changes over the next week or over the next few weeks. So we're saying the refinance index decreased 0.3% from the previous week, but gosh, up 44% from the same week 1 year ago. So obviously having a huge influx of people who are refinancing their mortgage right now because of record low interest rates. So the unadjusted purchase index decreased 1% compared from the previous week and was 24% higher than the same week 1 year ago. So basically we're seeing, compared to 1 year ago, the level of mortgage applications is up significantly, 44% higher, at least the index is, compared to a year ago. And then for the purchase loan activity, up 24% compared to 1 year ago. In addition, they say that mortgage applications for refinances and home purchases both decreased slightly last week, despite the 30-year fixed rate mortgage decline to a new MBA survey low of 3%. Obviously, according to Freddie Mac, I believe that number is around 2.9%, but within a reasonable range. In addition, the MBA said that the refinance share of mortgage activity increased to 65.6% of total applications. So obviously, the vast majority of the mortgage applications is from refis. In addition, the adjustable rate mortgage, or ARMs, share of activity decreased to 2% of total applications. That's a great number to see, that number being very low, because those are loans that tend to be having a little bit more risk factors associated with it, just because the fixed rate term is a lot less than a 30-year fixed rate mortgage. So in addition, they say the average contract interest rate for a 30-year fixed rate mortgage with conforming loan balances, that's $510,000 or less, decreased to 3%. And a friendly reminder here, the MBA, they do have this weekly survey on their website, but the survey only covers 75% of all U.S. Retail residential mortgage applications. So it's not a picture of the entire mortgage market, but a very high percentage of it. All right, so speaking of mortgage applications, let's talk about housing affordability. I found this really interesting article on the National Association of Realtors website, and they're saying that housing affordability weakens in August 2020 as home prices rose faster than the median family incomes. I was actually really surprised by these numbers here, so I'd love to know your thoughts about it. So they're saying that the median family income rose 2.2%, while the median home price rose 11.7%. And they said the effective 30-year fixed rate mortgage fell to 3% in this August compared to 3.08 in July. So mortgage rates are obviously at an all-time low compared to a year ago of 3.66%. And this is really important. So obviously we have a drop of interest rates of from 3.66 to around 3%, but home prices have increased around 11.7%. So this is the Housing Affordability Index, complements of the National Association of Realtors. So this is over a year span. So obviously we had the pandemic that really hit us in March, and then that was when people took their house off the market. Real estate agents and across the country in many states, including California, where I'm a real estate agent, we weren't allowed to meet with our clients face-to-face for about a month. Therefore, it makes sense that the House Affordability Index increased in April, but it really peaked around May. And this is really when home prices really started taking off, when we had the ease of restrictions of real estate agents who could meet with their clients. So the affordability index dropped, meaning that it became less affordable to buy a house. Now we're at index of 158.9, but this is really interesting to see compared to August of last year, it's right in line, only 1 point off. So even though we have home prices that have skyrocketed, the drop of the interest rates really have had a balancing effect on that. However, we'll have to see if home prices continue to soar, which I don't really anticipate since we're going into the fall winter months. And then if interest rates do not decrease, then this affordability index should drop a little bit further. But we'll have to wait and see, and I'll keep you posted about that. So they said the most affordable region was the Midwest, and obviously the least affordable region remained in the West, obviously. Houses are expensive in the West, of course. They also have a great graphic here. Last graphic I want to show you here on their website here, the median family income and qualifying income. So in the U.S., the qualifying income for a medium home was $50,000, but the median family income was $81,000. So a big difference, about $30,000 overall in the U.S. of what you need to qualify in order to get a home overall in the U.S. However, when you look at the West, qualifying income is $75,000, but the median family income is $86,000. So only about $11,000 difference there, and it's not that big of a gap there, especially when you compare it to the South, the Midwest, and Northeast, where the median family income is far greater than the qualifying income that you would need in order to buy a house. So I thought that was interesting. All right, so changing gears here, we want to go over commercial property. And this is again on the National Association of Realtors website. So they're saying the office property suffered large occupancy losses with likely full recovery in Q2 of 2022. So a number of years to go before we reach full recovery in the commercial real estate market. So he said that amid the job losses, business closures, and about 40 to 50% of office workers still working from home, office vacancy suffered its biggest loss yet in the second quarter of 2020. And the West and South regions suffered the biggest losses, led by San Francisco, New York, Phoenix, Los Angeles, and Dallas. In addition, they say that the office space occupancy fell by 22.8 million square feet in Q2 of 2020. That's a significant amount of square footage that was lost during this pandemic. The West region accounted for about half of that loss. So this is really interesting to see this. So let's look at Q1 2020. This is right here where this is, again, US, Northeast, Midwest, South, and West. They're all at just about zero. So meaning they're almost at 100% vacancy during this period of time. But what happened? Stay-home orders, the pandemic hit. A lot of people started working from home. In the US, is absolutely just tanked. So now we're at 22.8 million square feet negative. It's just in one quarter alone. That's the US as a whole. And then you look at the West, had the biggest drop, 11 million. And the least amount was the Midwest of 1.2 million. In addition, they have this great graphic here showing square feet of occupancy losses in Q2 versus Q1. San Francisco, New York, Phoenix, Dallas, and Los Angeles atop the charts there. They also have a great graphic here showing the vacancy rates in the US by different cities in the US, where Charleston was one of the lowest in the country, only 8.2%. But really interesting to see that San Francisco was only 9.9%. So very low on this vacancy rate chart because you look at Houston had one of the highest vacancy rates of 21.1%, followed by Brooklyn, Los Angeles, Atlanta, Chicago, and Dallas. All right, so that is the commercial real estate update for you. I want to show you too Yelp. We all know Yelp for reviews, but they also keep track of businesses that actually close on their app or on their website. So they have it by region here, and they have they call it the local economic impact report. They have this posted I believe it's every quarter, if I'm not mistaken. In any case, where are the businesses being closed right now? So here's our geographical areas with the largest number of businesses closed since March 1st when this pandemic hit. And Los Angeles had the biggest amount or the highest amount of closures in the U.S. By U.S. Metro. So permanent closures, 7,500, and temporary closures, another 7,500. So almost 15,000 businesses that have closed in the Los Angeles Metro since March 1st. Then again, followed by New York and San Francisco. However, it was really, and then California had the highest amount of closures in the entire country. But when you look at closures per 1,000, Honolulu, Hawaii topped the charts at almost 25,000 closures per 1,000. And then it's really interesting to see here, these are really kind of like the vacation destinations. And obviously there's not as many people going on vacation in Hawaii and San Francisco, Las Vegas, and San Diego right now. And that is really reflective of these numbers here because they're showing really high business closures per 1,000 in the US. And that's today's housing market update. I hope you enjoyed that. If you did, please hit the like button. I greatly appreciate that. Also subscribe if you haven't done so already. I post videos about how this pandemic is affecting our real estate market as well as personal finance topics. So please join the family if you haven't done so already. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day and look forward to seeing you on the next video.